Hello and welcome, future traders. Today, we're exploring the essentials of stock market charting. It's the art of visualizing data points on a graph, representing a stock's performance over time. These charts are instrumental, guiding traders to make informed decisions based on historical trends and patterns. They are your compass in the vast sea of stock trading, helping you navigate through and spot potential opportunities. So, are you ready to master the basics? Let's dive right in. First off, we have different types of charts that traders use. These are the tools of the trade, so to speak, and each one has its own unique strengths. Let's start with line charts. They're the simplest of the bunch, plotting price points at regular intervals and connecting them with a line. Picture a heartbeat monitor, but for stocks. Line charts are great for spotting overall trends, giving you a bird's-eye view of a stock's performance. Next, we have bar charts. Each bar represents a trading period, and the top and bottom of the bar represent the highest and lowest prices during that period. The left notch is the opening price, and the right notch is the closing price. Bar charts are like line charts, but with more detail, providing a fuller picture of the stock's activity. Then we have candlestick charts, the most detailed of the three. Each candlestick shows the opening, closing, high, and low prices for a specific period. The body of the candlestick represents the range between the opening and closing prices, while the lines, or wicks, show the range of prices outside of the opening and closing prices. The color of the body tells you whether the stock price increased or decreased during that period. Candlestick charts offer a depth of information, making them very popular among traders. Remember, each type of chart serves a different purpose, and it's essential to know when to use which. As you continue your trading journey, you'll likely find that you prefer one type over the others, and that's perfectly okay. After all, the best tools are the ones you know how to use well. One of the most popular charts among traders is the candlestick chart. These charts are like a visual diary of what's happening in the market. They are composed of individual candles that tell us a story about the stock's price movement during a specific time period. Now let's talk about the anatomy of a candlestick. It has a body that shows the opening and closing prices, and the wicks or shadows that show the high and low prices. If the body is filled or colored, it means the stock closed lower than it opened. On the other hand, if the body is empty or uncolored, the stock closed higher than it opened. But the real power of candlestick charts lies in their patterns. These patterns can suggest the direction the market might be moving. For instance, a doji pattern, where the opening and closing prices are nearly the same, could signal that the buyers and sellers are in equilibrium, and a change in direction might be coming. Another pattern is the hammer. This pattern forms after a decline and could indicate a potential bullish reversal. Its small body and long lower shadow suggest that sellers drove prices down, but buyers were able to push the prices back up. And then there's the bullish engulfing, a pattern that forms after a decline. It's made up of two candlesticks, the first small and filled, followed by a larger uncolored one. This could suggest that buyers have taken control from the sellers. Each pattern can give us clues about potential market turns and sentiment, so understanding them can be a powerful tool in your trading toolkit. Let's now discuss some technical indicators. These are powerful tools that can give you a glimpse into market trends and momentum. First up, we have moving averages. They help to smooth out price data over a specific period, whether it be a few days or a couple of months. By doing so, they offer a clearer picture of the overall trend, free from daily price fluctuations. Next up is the Relative Strength Index, or RSI. This nifty indicator measures the speed and change of price movements, effectively telling us if a stock is overbought or oversold. When the RSI is above 70, the stock may be overbought and it may be time to sell. Conversely, if it's below 30, the stock could be oversold, potentially presenting a buying opportunity. Last, but certainly not least, we have the Moving Average Convergence Divergence, or MACD. It's a tad more complex, but incredibly valuable. The MACD helps identify potential buy and sell signals. It does this by comparing short-term and long-term price trends. When the MACD line crosses above the signal line, it might be a good time to buy. But if it crosses below, it might be time to sell. These indicators help us understand the momentum and trend of the market. They're not crystal balls, but they can certainly help us make more informed decisions. Another important aspect of charting is understanding timeframes. In the world of stock trading, time is indeed money, and how you choose to measure that time can make all the difference between a profitable trade and a missed opportunity. From intraday charts that track price movements by the minute to monthly charts that show long-term trends, timeframes provide context to stock price movements. Intraday charts are typically used by day traders who buy and sell stocks within a single day. These charts can help identify short-term trends and potentially profitable trades. On the other hand, longer time frames such as weekly or monthly charts are often used by swing traders and investors. These charts can reveal broader trends and patterns that may not be apparent in shorter time frames. For instance, a stock may appear to be in a downtrend on a daily chart, but could be in an uptrend when viewed on a monthly chart. Choosing the right time frame is not a one-size-fits-all decision. It depends on your trading style, risk tolerance, and investment goals. Day traders might prefer shorter time frames for quick trades, while long-term investors might prefer longer time frames to evaluate the overall health of a stock. Remember, each time frame offers a unique perspective, and using multiple time frames can provide a more comprehensive view of a stock's performance. The right time frame depends on your trading style and strategy. Now that we know the basics, let's read a complex stock chart together. Imagine a bustling market with traders making decisions based on this visual representation of a stock's journey. The first thing you'll notice is a series of peaks and valleys. These are the stock prices. Pay attention to the trend lines, drawn to connect these highs and lows, giving us a picture of the stock's overall direction. You'll see horizontal lines marking areas of support and resistance. These are price levels where the stock has historically struggled to fall below or rise above, acting as psychological barriers for the market. Also, take note of the volume bars at the bottom of the chart. These represent the number of shares traded during a particular time period. A sudden spike in volume can signal a strong sentiment among traders. Reading a stock chart might seem overwhelming at first, but with practice, it becomes second nature. Before we wrap up, let's talk about some common mistakes new chartists often make. One of the most frequent missteps is relying solely on a single indicator. Remember, indicators are tools to help you make informed decisions, not crystal balls predicting the future. Therefore, always cross-check with multiple indicators to get a more comprehensive view. Another pitfall is letting emotions drive your trading decisions. The stock market is not a place for heart over head. It's crucial to stay objective and not let fear or greed cloud your judgment. Lastly, never ignore the overall market trend. Even the most promising stock can tumble in a bear market. Always keep an eye on the broader market conditions and let the trend be your friend. Avoiding these mistakes can save you from unnecessary losses. Remember, in the world of trading, knowledge is power, and avoiding common pitfalls is half the battle won. And that's a wrap on the basics of stock market charting. We've journeyed through the types of charts, deciphered candlestick patterns, and demystified technical indicators. We've explored different chart time frames and learned to read a stock chart like a pro. We also covered some common mistakes to avoid. Remember, the best way to learn is by applying these techniques in real or simulated trading scenarios. If you enjoyed this introduction and want to get more detailed guides, make sure to hit the subscribe button and turn on notifications.